Nowhere in his explanation for the inflation of the 1970s was the Fed. Right? All the money they printed during the 1960s, the Great Society, the war on poverty, the Vietnam War, the deficit spending, the guns and butter, going off the gold standard 1971, nothing about that. So the government had nothing to blame. Wasn't because of big deficits. It wasn't because of easy money. It was because oil prices went up and people just expected inflation. Well, the reason oil prices went up was because they printed so much money, because they went off the gold standard. The reason people expected inflation is because they weren't idiots. They knew there was inflation. They could see it. And so they obviously expected, what was clearly coming. We had high inflation and it was going to continue. Those expectations and those price shocks were the result of the Fed policy, right? But if Bernanke doesn't understand that, if he doesn't know why we had inflation during the 1970s, then why the hell would he know why we have inflation now? In fact, if he didn't understand why we had inflation in the 70s, why was he even the chairman of the Federal Reserve? Well, you already know the answer. It's because he doesn't understand inflation that he became chairman of the Federal Reserve. Because if he knew why we had inflation in the 1970s, he never would have been appointed. He wouldn't have been vice chair. He wouldn't have had a seat at that table if he understood where inflation came from. Then he also complained, right, about how hard it is for the Fed to make policy based on numbers that are so frequently revised. So that was very frustrating. We'd get a number, whatever it is, CPI, GDP, some kind of number would come out, employment, and then we would make policy off of that number, and then the following month they would completely revise it to some other number. And, what I'm thinking is they shouldn't even be making policy off of a number. I mean, what difference does a number make? One low number. And now you're going to be upset if the number gets revised when you know that all of these numbers have a history of getting revised. And if they don't get revised immediately, like the next time, sometimes they go back 6 months or a year later and they revise everything. These numbers don't mean anything. They shouldn't need these numbers to make policy. They should be able to understand the bigger picture and the implications of what they're doing. So when you're flooding the economy with money, right, when you have 0% interest rates and your balance sheet has exploded, you don't need to look at the numbers to know that you've got an inflation problem. Right? By the time that inflation problem shows up in these numbers, it's way too late to do anything about it. The problem is we don't have FOMC members or chairs that know enough about economics not to need these stupid numbers, to be able to understand the broader implications of what they're doing. But again, as I said, if they understood the broader implications of what they were doing, they wouldn't have those jobs because they don't have their jobs because they're smart. They may have those jobs because they're dumb. I mean, they're not dumb in an intellectual. I mean, I'm sure if Bernanke or Powell, maybe, I don't know about Powell, but I mean, but Bernanke, I think, if you gave him an IQ test, I think he's pretty smart. I think he's got a higher IQ than I do. I don't know about Yellen, but I mean, who knows? So it's not just about raw intelligence. It's just understanding economics, because you can be really smart. And look, Albert Einstein was a genius, but I think he was a Democrat. I mean, he wasn't smart enough to understand that these social programs don't work, because I don't think he actually spent any of his time thinking about it. He had more important things to think about. And so when it came to politics, he just used his heart. He didn't use his magnificent brain to try to focus on economics. He had more important things to think about. And so, you could be smart intellectually, right? I mean, Karl Marx was probably a pretty smart guy, right, to come up with Marxism, but it was an asinine theory. But I mean, you have to be pretty smart to come up with it, right? You can't be a complete idiot. But the people who don't understand economics, they're the people on the Federal Reserve. But anyway, the epitome of a lack of understanding of economics and money and inflation is the current head of the Federal Reserve, Jerome Powell. And I'm going to talk about what Chair Powell had to say at this event. Okay, we are back. I want to start off by reading some quotes from Powell. This got kind of a lot of press, and it caused people to think that maybe the Fed is pausing. Because remember, on my last podcast that I recorded on Thursday, that was the day before Powell and Bernanke spoke. But on that podcast, I talked about how 3 Fed officials had come out that day, and they really talked tough about why we need more rate hikes and why we're going to hike in June, that we can't pause because inflation is still a big problem. And so the markets didn't like that and reacted. Gold got hit and everything. Well, gold rallied, I think, $20 on Friday because of what Powell said, because now all of a sudden Powell put the pause back in play. That is the June pause for this upcoming meeting. But so here's what he said. Quote, the financial stability tools help to calm conditions in the banking sector. Right? Developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So Powell thinks that these tighter credit conditions are going to push down economic growth and inflation and hiring, because he thinks inflation is a byproduct of hiring and economic growth. He's wrong. See, he thinks tighter credit is going to hurt the economy, which is going to, put downward pressure on inflation. It's not. It's actually going to put upward pressure on inflation. He just doesn't understand that. Let me finish the quote. So as a result, our policy rate may not need to rise as much as it would otherwise have had to achieve our goals, right? So in other words, Powell said, wait a minute, because of these tightening credit conditions that just happened because of the banking crisis and the effect that these tighter credit conditions are going to have on employment, the economy, and inflation, we may not have to raise as much as we thought. So in other words, we can pause, right? This is what people were reading into those remarks, and, it makes sense based on what he said. Then he continued. He said, we've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent bank stress. So he's saying, hey, we've come a long way and our current policy is tight. So according to Powell, 5% Fed funds, 5 to 5.25, is tight. It ain't tight. It's still easy. It's just less loose than it was, but it's not tight because inflation, even the way the government measures it, is 5%. So you're talking about 5% inflation, 5% rates, 0% real. You're not restricted. Remember, when interest rates were 20%,